Oh, hi. Have you heard about ETFs? Have you seen it in the newspaper, a magazine, or you've read it on the internet? And you've been wondering, what in the world is an ETF and how do I make money with it? Well, you're in luck. That's what we're going to talk about today.
Hey everyone, Patrick here with another video in the One in the World investment series, where I try to demystify some of the basic investment concepts to help you build your investment strategy. Now, ETFs are extremely important, regardless if you're invested in the stock market or not. They're used by almost every trader, and in this video, I'm going to show you what they are, the different types, how to use them, and at the end, I'm going to show you some of the ones that I follow every day and I strongly recommend that you also start following because they'll give you a good indication of where the market's going. Now, you guys know the drill. Please like and subscribe to the video. It really helps out and it's going to be your good deed for the day. It's going to make me very happy. So let's get on with the video.
So, what is an ETF? Well, ETF stands for Exchange Traded Fund, which, if we break it down, is a fund that's traded on the stock market, like any of the stocks that you guys already know of. But what's different about them is that while a stock tracks one company, the investment vehicle tracks one stock, an ETF can track almost anything, any number of things. So the best way to imagine it is imagine like a basket like this one. This is my Easter basket. For some reason, right now, my wife put rocks in it. So don't ask me why. I don't know. But it doesn't have a lot of value. But imagine that this is an ETF, right? Depending on what you put in it, it's going to have different values. If you put a coin of silver in it, right now it's going to be worth about $15. If you put a share of Facebook, right now it's going to be worth $200 or $210. So that in itself doesn't bring in a lot of value. What brings the value is the fact that in one ETF you can add a lot of different investments. So for example, instead of having one share of Facebook, well, what if you have 100 shares of Facebook, 100 shares of Google, and 100 shares of Apple? Well, now you have a lot more exposure to big tech, right? And at the same time, if you want to add a fund that has a lot of different oil industries companies, well, then you'll have exposure to oil without owning individual stocks or owning the commodity. Same for silver, for example. I personally, I've talked about it before. I don't want to own $50,000 of silver in my house, but I can buy into an ETF that carries silver, and I have exposure to the precious metal without having to deal with it myself. Now, as for the types of ETFs there are two things I want to talk about. Number one is active versus passive. Actively managed ETFs means that there's an administrator that actively, on a day to day basis, makes adjustments to it. A passively managed ETF means that they're not doing changes all the time. When you buy into an ETF, you buy into a prospectus which lists the investment strategy of the fund. So the administrator's goal is to follow through on that investment strategy. They're not going to change the strategy based on what the market does. They follow the prospectus. So that's very important to know before you buy into any ETF. Try to figure out what the prospectus says because that's basically the investment strategy that you're following. Now, the second thing I want to tell you guys about is that within those actively and passively managed funds, there's a wide spectrum of types of ETFs. You can have corporate bond ETFs, you can have commodities, precious metals, you can have ETFs that track a certain industry, for example, big tech or pharma. And then at the same time, you have other ETFs that try to simply act as index funds, and they track a certain index, such as the S&P 500 or Nasdaq or some of the other index. That's basically the wide range of ETFs. So no matter what you guys are looking for, you can find an ETF for that, and I'm going to show you many later on in the video. So you may be thinking, wow, Pat, that sounds a lot like a mutual fund. So what's the difference between an ETF and a mutual fund? And why is the ETF considered a little bit better? Well, obviously, it depends on your needs. I'm not your financial advisor, so consult your professional, right? But the reason why traders prefer ETFs is that they can be traded intraday. So you can buy and sell them like any other stock during the day as opposed to mutual funds, which are transacted at the end of the day. You can't buy and sell your position as easily. And another reason why they're more popular these days, especially with long term buy and hold investors, is that the expense ratios are usually lower. And the reason why is because a lot of these ETFs are index funds, which are passively managed. And being passively managed, there's not a lot of management involved, there's not adjustments to be made. So they can't justify charging you 2% per year in management fees. As opposed to in a mutual fund, that's basically what they promise you is that they're going to be actively managing it and adjusting it based on what happens in the market. And for that, they charge a fee. Well, you avoid those fees when you buy into a passively managed ETF, and that's why they're popular with long term investors. Now, just to be clear, new mutual funds have been created that also have lower fees because they wanted to compete with the low fee ETFs. But despite that, I still prefer the ETFs, most notably because of the versatility that they provide.
Now, guys, I'm going to show you some of the ones that I actively follow and that I really suggest that you pay attention to. You don't have to invest in them, but at least keep in mind that a lot of the traders are paying attention to these ETFs when they're making their decisions, and they have a big impact on the market. So the mother of all is the SPY, which tracks the S&P 500, the biggest companies in the US. So the reason why the SPY is so important is that obviously not only is it the most traded ETF, but when the economy is doing well, or people have the feeling that the economy is going to be doing well, the SPY is going to go up. When people believe that the economy is going down, the SPY is going down. So, for example, in 2020, when we have the pandemic and the stock market plunged, well, the SPY crashed. And now that people are thinking that it's going to go back up and the economy is picking back up, the SPY is going back up. So if you want to bet on the economy, you can bet on the SPY, and there's going to be a big correlation between the two. Inversely, if you're bearish on the economy, you can bet against the SPY, and again, you'll find that correlation where if the economy is going down, your investment is going to go up. So the SPY is very important, and a lot of decisions are made based on its movement. Now, I'm big into commodities and precious metals. So some of the ones that I actively follow are GLD for gold, which tracks the price of gold approximately. Not exactly, but they own gold, so you'll find a correlation. Same for SLV, which stands for silver. Those are for precious metals and they're actively traded in the stock market. So GLD and SLV. Now, for oil, I used to track USO, but after the debacle in 2020 with the oil going to negative $37, I stopped following USO. Now I follow XLE, which is energy sector ETF. Now, if you go for sector ETFs, which are also very important for you, especially if you want to bet on certain sectors versus the economy or versus other sectors, well, you have the financial ETF, which is XLF. So if you're interested in betting on financial companies without buying specific banks or insurance companies, you can go for the ETF, which is going to have a basket of all of those companies. So XLF. And then for tech stocks, one of the very, very popular ETFs is QQQ, which tracks the biggest tech stocks on the NASDAQ. And again, that gives you an exposure to those companies without owning the single ones. So QQQ is one of the ones that you can look at. I know the symbol's a little bit funny, but it's one of the most traded ETFs on the market.
So let's start with the basics. As I touched on earlier, one of the main benefits to ETFs is that it lets you get diversity without having to manually day to day pick stocks. And let's be honest, almost everyone, including myself, we're not the best at managing a portfolio. That's not really our strength. You might find one or two good stocks, but are you going to, on a day to day basis, like manage the quantity that you have of each stock? Probably not. Like, if especially if you have a day job, you can't just track it all day, every day, and be up to date on the news and everything. So with an ETF, all of that is done for you. And long-term studies have shown that in a lot of cases, just owning an ETF passively, for most people, gets better results than actually stock picking yourself. It's just the way it is, right? So it lets you get diversity. You can be passive, and over time, your portfolio will probably grow. But not only that, it lets you get access to certain assets that normally, as a normal retail investor, we don't really get access to, or we don't get very good terms. For example, I mentioned a lot. If I want to buy silver, I can't really go to a refinery and buy large quantities of silver or gold or oil, stuff like that. So what's really cool about it is that even though it doesn't let you pick individual stocks, you're basically picking an entire industry. So that lets you go long or short on a broad industry or the market as a whole. If you're looking for an index fund like the SPY that tracks the S&P 500, which a lot of people, most people believe represents kind of the economy, like big companies that cover basically every industry that we have in the US. But wait, there's more. Not joking, there's two more ETFs that I want to quickly touch on. You have the inverse ETFs and you have the leverage ETFs, which you couldn't do with a simple company. Now, leverage ETFs, as it says in the name, there's leverage built in, usually two times or three times. That means that as the investment that it tracks goes up, the ETF is going to go up twice or three times as much. If the underlying investment goes down, the ETF is going to go down twice or three times as much. This lets you do a lot of cool things like hedge your position. Let's say that I think something is going to go down and my position is at risk. Well, if I buy a triple leveraged investment that goes in the opposite direction, well, as my investment goes down, this is going to go up and balance it out. Now, inverse ETFs, all it means is that it goes in the opposite direction of what it tracks. So if you're tracking the S&P 500, as that goes up, the ETF is going to go down, and as the S&P 500 goes down, the ETF is going to go up. This lets you play on the movement without having to short the stock. So you don't need that very often, but that's another option that's available with ETFs that you can't really do with a normal stock.
Now you have to understand that there are hundreds of ETFs that cover a lot of different sectors. So what I'm going to do is I'm going to link in the description one of the web page where you can find a long list of them based on trading volume because you want something that's liquid. So the more trading volume it has, the easier it's going to be for you to buy and sell them. And that's one of the key things that I look for. I don't want something that I'm going to be stuck with. I always want to have people that are going to buy and sell with me. That makes it a lot easier to enter and exit your position. Well, that's it for today, guys. Thank you for watching. I hope you learned a little bit. ETFs provide a lot of value and let you do some strategies that you couldn't necessarily do with normal stocks and let you diversify. So I hope this gave you a few ideas and some of the more advanced strategies I'll talk about in future videos. So stay tuned for that. I'm looking forward to seeing you there. And I hope you have a nice day. Please like and subscribe. It really helps me out.